Hi, this is Lloyd Silver, CEO of Pravada, and today we're going to talk about Annuity Care from State Life. This is one of our favorite products right now. It solves a huge problem for clients and has a unique place in the market. And during this short video, we're going to tell you how some of our producers are driving huge amounts of business with this fantastic product. Gallup did a survey, and here's what they found out. 81% of annuity owners intended to use their annuity to minimize the likelihood that they need to rely on their children financially. And 74% said that they intended to use the annuity as an emergency fund in case of catastrophic illness or if they need to pay for long-term care expenses. This is why your clients will love Annuity Care. Today we're going to talk about Annuity Care 1. There's a new version called, you guessed it, Annuity Care 2. But the original product is available in more states, so we're going to go ahead and focus on that. It's a single premium deferred annuity, similar to annuities that have been sold for decades. But it has a few special features, the most important of which is the ability to access cash value for qualifying long-term care expenses. What's a qualifying long-term care expense? With Annuity Care, it pretty much covers everything your clients would need. Nursing homes, assisted living facilities, home health care, hospice and respite care, and even adult daycare. And the great thing about Annuity Care is not only does it offer a competitive rate of return to build up tax-deferred cash safely, but it pays an even higher interest rate on funds that are withdrawn to pay for long-term care expenses. So, if your clients need long-term care, State Life recalculates the account value and credits a higher interest rate for the funds used to pay for that care. The maximum amount of funds they can take out of the policy for long-term care on the monthly basis is designed so that the funds are paid out on a level basis for 36 months. So if the account value was $36,000, the maximum amount per month for long-term care would be about $1,000. It's actually a little bit higher because they do factor in interest even while you're taking out funds for long-term care. And there's an optional rider that can be added to extend those benefits beyond 36 months for a total of 72 months or even for the lifetime of the annuitant. The premium for that rider is guaranteed. It can be paid either in a single premium or annually, and you can add an inflation rider to it. There is no other annuity out there that we're aware of that offers these benefits. The underwriting in this product is simple. If you've had clients who haven't been able to qualify for a standalone long-term care policy or even other asset-based long-term care policies, they will likely qualify for Annuity Care. And this is the best part. This annuity is Pension Protection Act compliant. What's that mean? The Pension Protection Act went into law back in 2006, but there was one provision that didn't go into effect until January 1st of 2010. And even though it's been over a year since that provision has been law, agents and consumers still haven't taken widespread advantage of it, which creates a huge opportunity for you. The provision allows individuals to withdraw funds from specially designed, non-qualified annuities to pay for qualified long-term care expenses on a tax-free basis. Let me say that differently. If your clients own one of these new annuities, like Annuity Care, designed specifically for this provision, they could pay for long-term care expenses without having to pay any tax. This is huge. And here's the enormous opportunity. It's okay to 1035 older annuities that don't qualify under the Act into a new one that does. So you could take a client that has an older annuity, even if it has huge taxable gains, because it's been earning interest on a tax-deferred basis for many years, move it into Annuity Care, and your clients can now take those funds out of the policy on a tax-free basis if they use it to pay for long-term care expenses. This is a simple conversation to have with clients and prospects. They're going to love this idea. Let's look at how annuity compares to an older annuity that isn't covered under this Act. In this example, the old annuity was purchased for $75,000, and there are $75,000 of tax-deferred gains, so the total value is $150,000. If they need to use those funds for long-term care expenses or any other reason, tax law says it's on a last-in, first-out basis. That's called LIFO. And what that means is that it's assumed the gains are taken out of that policy first. So they have to pay tax on the first $75,000 they take out. So $75,000 becomes maybe $40,000 of funds that can be used for long-term care. The remaining $75,000 would be available to them with no tax because it's considered a return of basis. If instead they do a 1035 exchange into Annuity Care, they can take out the entire $150,000 on a tax-free basis, absolutely no taxes, if they use it for long-term care. So in the first example, the clients would net about $115,000. That's the return of their original $75,000 premium plus the after-tax amount of the gains. But with Annuity Care, they'd get $150,000 for long-term care. Any client, even remotely concerned about long-term care, will see the huge benefit of moving funds over to Annuity Care. And of course, Annuity Care also allows for the purchase of extended long-term care benefits as well, something their older annuity would not offer. We've talked about 1035 exchanges, but of course that's not the only source of funds for Annuity Care. Clients that are stockpiling cash or have passport savings accounts would be ideal candidates, especially those that are repeat purchasers of CDs, or perhaps they have money sitting around because they've downsized their home. It's perfect for the senior market and those approaching an older age. Some people don't want to buy a standalone long-term care policy, since if they don't need benefits, their premium is basically gone. So they like Annuity Care because it's still available as an asset, earning a competitive interest rate even if they don't need long-term care. And there are others that simply can't qualify for long-term care policy, but it's quite likely they'll be able to qualify for Annuity Care. It's a pretty simple application process. It's an annuity, so there is some paperwork, but we can help you with that if needed. There's no examination, no lab work, no blood taken, just a short telephone interview between the underwriter and the annuitant. And in our experience, we've had a 95% approval rating in about 30 minutes. You can sit down with a client, review Annuity Care, schedule the phone interview for right then, get approval, and close the deal in just about an hour, providing a great benefit to your clients in the process. If Annuity Care seems like it would be a good fit for your practice and your clients, let us know. We've created a microsite at www.privada.com/state-life-annuity-care. On that microsite, we have everything you need. All the marketing materials for this product, including pre-approach letters and brochures. You can view an extended webinar, request an illustration, get contracted with State Life. Most of the materials on the microsite are for financial advisor use only, so we do require that you register on our website to gain access to it. But of course, if you want to just give us a call, do so at 415-369-9990. And if this sounds like a great idea, but you just don't have the time to do it yourself, we've created a service to specifically help with those types of situations. It's called the Opportunity Maximizer, and it's an easy way to market Annuity Care or any other concept to your clients with a minimum investment of time or money on your part. Thanks for watching, and everyone at Privada appreciates your business.